Good morning. This is another Two Graybeards Explainer, and I'm really excited to talk about this today with you because I think every investor has to be considering, whether bull or bear, has to be considering a very simple to understand trade at this stage for any type of portfolio that is long equities. Most investors should be long equities as part of their core portfolio of beta. It is the best long-term way, a core beta portfolio is the best long-term way to earn money through time by having a balance of equities, bonds, commodities, gold, and a broad range of assets that diversify. But today, equities have had a significant rally this year. Nasdaq's up 30%, the S&P made a new high, up over 10%. There's been quite a rally in equities. And at the same time, and this is the unusual part and why I think there's just a tremendous opportunity right now. Again, whether you're bullish or bearish, or like me, not sure. The implied volatility of options, which is really the price of options relative to what they offer in terms of return, is made a new low yesterday. That we're recording this on June 17th. And that gives a tremendous opportunity for investors. So what I'm calling this explainer, you should see it on the banner, is stock replacement trade. What is a stock replacement trade? Let's just assume you're a beta investor and you own stocks. Like most of us, we all own stocks. It's unless we're an alpha trader trying to time markets, and that's very hard. I do it. I'm fairly bearish on stocks. I have to be honest. I think they're overpriced. But that has nothing to do with what we're talking about today. It's not a view. It's what you do when the market presents itself and you are desire to permanently invest in the stock market. Should you just sit there and not take advantage of opportunities? Sometimes that is the best approach. But this is a unique time, just something I haven't seen in my 37 years of career, where you can, except a few times, a handful of times, where you can actually craft a portfolio that's better than just sitting on your hands. So how do you do that? Now, if you are a high net worth investor, like our clients are supposed to be here at Two Graybeards, you have a financial advisor, and they may sometimes say, have you thought about a stock replacement strategy? Have you thought about buying puts? Now, those two things are actually the same thing. And I think that needs to be explained, because when you hear that, you're like, stock replacement, gosh, I like my stocks. I've made a lot of money on my stocks. Why would I want to replace them? Let's explain. So I'm going to share my screen. Hopefully this works well, and go through what I mean. So here we have something we call the VIX. And I'm just going to jump right into this. So we're talking about options. That's what we're talking about when we talk about a stock replacement. And a stock replacement is replacing a long, say, let's use SPY, SPY, the S&P 500 spider. Say you have 100 shares of the SPY. Your payoff pattern is going to look like this. If we're around 440 here, you're going to collect $3 of dividends over the next 90 days or so. And if the stock moves in this way, in this fashion, if it goes up to 490, you're going to make $5,000 on your 100 shares. And if it falls to 380, you're going to lose $5,000 on your 100 shares. So, that's what you have. Perfectly fine if you're willing to allow your investment to move in that way. Sit with it. Totally fine. However, as I showed in the first graph, This represents the price of options over the last, I guess I did it for 20 years. And as you can see, sometimes the price of options during the financial crisis, during the COVID crisis, gets incredibly high. Now, these are supposed to be a proxy for 60-day options, roughly. It's not exactly that, but it's a proxy for 60-day options. So as you can see, option prices were very high when everybody wanted to protect their portfolio. And again, options were highest literally at the bottom of the stock market. And so some people look at the VIX as a gauge of fear because it sometimes can signal a bottom. On the other hand, it rarely signals a top. You look back over the last however long, mostly the VIX has ranged in this sort of range, which is okay. There's no signal to say, gosh, the VIX is low, so the market has topped. And you have to get short or you have to sell all your investments. It's mostly you just don't know. Now, since COVID, and in particular, since the beginning of the year, volatility has crumbled by 50%. Very sudden decline in volatility. Now, does that mean the market is going up? Not necessarily. It has gone up. Does it mean the market's going down? Not necessarily. It has gone down when VIX is low. Like it went down a lot when VIX was low. It went down a lot when VIX was higher. It goes down sometimes. Sometimes it goes up. Now, if you look at what's happened in the last few months, we've had an AI revolution that started with, has been going on for much of my career. I've been involved with AI for a decade, but the popular imagination and the usage of AI and the ability for anyone to either have their job replaced or their job enhanced by artificial intelligence really took off in January when Microsoft bought the new ChatGPT. And many others followed with some significant investments. And stocks like NVIDIA went up 4x, and stocks like Microsoft doubled. Google went up a lot. Tech in general and the QQs went up a lot. And that is, who knows? It seems like the beginning of what many are calling an artificial intelligence revolution. And it may pay off. The stock market may go up a lot more because of AI, or it could fall like other bubbles that have popped. I don't know. I don't know whether it's a bubble or not. Do you? Anyway, because I don't know, I find it interesting that volatility, which is at some level a measure of how much uncertainty there is, not necessarily bullish uncertainty or bearish uncertainty, just uncertainty, is very low, which means people are confident that for now, the stock market will be not particularly volatile. Not big drops, also not big further runs. Okay, fine. Now, what does that mean for my portfolio? So remember, we started with this slide. Here's what I got. And I'm long 100 shares of SPY, and I'm going to get that experience. Here's what I want you to do. And let's step back. I don't offer investment advice here. I'm not a licensed investment advisor. I'm asking you to think about speaking with your investment advisor and determining if this is right for you. I'm just going to explain how it works. It's up to you to decide. But here's an idea. I think you can do what is called a levered stock replacement transaction. And in that case, you sell all of your SPY, all the blue line, you sell. So you have no long equity anymore. But you replace it with 2 calls and no SPY, 2 calls on the SPY struck at the money, struck at where we currently are, which is around 440. What happens to you in the event that then, by the way, these are about 2-month options expiring in August, and they're worth about $9, $10. So if you buy them and at the end of August, middle of August, when they expire, the SPY hasn't changed, you're going to give up the max amount of money you could have given up, which, by the way, I didn't do it in percentage, but 100 shares of SPY is worth about $44,000. And this levered stock replacement is going to lose $2,000. So you're going to lose 5% on your investment. Now, that's not great. Don't get me wrong. I don't want you to lose 5%, but I also want you to know you made 5% like in the last 2 weeks. Okay. So do you want to put some of that winnings at risk? A lot of people are going to say, gosh, I want to be exposed to the upside in case this is really a continued rally, and paying for options is going to be expensive. And that's why I'm using this idea of a doubling of your leverage, because just up at 4,600, you start significantly outperforming if the market continues to rally. And importantly, and this is where the replacement goes. Why do you replace your stocks? Because the worst you can lose if you pay roughly $1,800 for your 2 call options is what you paid. And so if the market does fall back to 420-ish by August, which again is 5%, which it was at 420 like a week ago, you are going to be potentially significantly better off. So you've given up this range over the next 2 months that you aren't going to perform as well as if you're going to still make money if the market goes up from here. Once it gets to about here, which is about 450. So if it goes up 110 points, 100 points on the S&P, you're going to start making money again, but you're going to not make as much as if you just held. That's up to you. I think it's great. And the reason I think it's great is because this P&L in the past, like a few months ago, for the same payoff pattern, you would have had to essentially pay $4,000, not $2,000. You would have had to pay $4,000 to protect your portfolio. And so your payoff pattern would have done the same sort of hockey stick thing, where you would have had to have a significant decline just to break even, and you wouldn't participate until like way up here. So this little section where you underperform is due to the fact that this little thing has fallen so much. So this section of underperformance is much smaller than it's been. Now, are you really, this is to me the ideal way to stay in the equity markets and protect your downside. There are many other ways. And so I'm just going to run through them. When people start talking about this, you can understand what they're saying. And so the first thing is, you don't have to buy, you don't have to buy 2 calls. You can buy 1 call. In that case, sell your SPY and just buy 1, which is the equivalent ownership. In that case, it costs you a lot less, so you don't lose as much money as you would in the twice said, but you significantly outperform owning SPYs. But if the market goes up, you underperform. You underperform both the double and you underperform just having sat on your investment. You have to decide whether replacing your stock with 1 call and getting the orange line or replacing your stock with two calls is more suitable for you. For me, because of this, I like buying more than buying less. That's up to you. So now let's go back to some other important things about stock replacement. When you do a stock replacement, whether you buy one call or two calls, there's a problem. You're selling your stock. And if you've owned that stock for a long time, you're going to realize a long-term capital gain. And if you have owned it for a short time, you're going to realize, presumably, a short-term capital gain. Neither are good things. You don't want to pay taxes. So there's an alternative to that. And that is, instead of doing what I suggested, which is selling all the stock and buying two calls, you could do this. So here again is the blue line that we had of just owning your stock and doing nothing. And here is two different options. The green option I described is buying two calls and selling your stock. And again, taxes, if you do it in a tax-free account, less of a big deal. If you do it in a taxable account, you have to check your tax advisor. But there's also something, now I drew it more exactly because I didn't want to deal with something called carry instead, but the payoff pattern is essentially identical. For all intents and purposes, it's identical. You can stay long your SPY, stay long your 100 shares, and instead of buying two calls, buy one call and one put. Okay? So the call that you buy plus the stock that you own gives you the yellow line. And the put that you buy gets you the protection on the stock that you hedged. So another way of doing a stock replacement is just to hedge your stock with a put and keep your upside with a call. In other words, for that is you started your original position with long one SPY and bought a put and a call. And that's called a straddle. And it looks like this. You're buying this gray-orange combination line. Anyway, some of you are going to say, I don't want to own any of this upside. Now, that is not a stock replacement trade, and I'm not encouraging people who are invested long-term in equities to sell their equities and buy puts. If you did that, and it was a bet that you wanted to make, instead of having this payoff pattern, you sold all your stock and just bought a put, you'd lose money on the upside, you'd not participate in the upside, and you'd make a ton if the market fell. That's up to you. I don't love that idea at all. Now, if you are, and this, when I say I don't love that idea, I actually love it quite a bit, but that's for my alpha trading, not my long-term portfolio, not your portfolio. Your portfolio is long equities through time. And so when I think about that, I think about this. You're long these equities, volatility is low, replace your stock by either selling all your stock and buying one or two calls, or keeping your stock and buying one call and one put. I know this was fast. I know this was lots of charts that came up, but it's super important right now to think about your portfolio and judge not whether you want to bet on it going up or down, but just the vehicle that you want to have that exposure on. And in my view, right now, stock replacement trades are about as good as I've seen them. except for a handful of other occasions, which they were about as good. A combination of large macro uncertainty, a new popular technology innovation that's creating tremendous moves in markets, a recent significant rally, and extremely low volatility. To me, to Nick at Two Gray Beards, which we're doing this for our actual portfolio for our clients, stock replacement, and even in our case, a levered stock replacement, which is really not bullish, just really wanting to take exposure to this pricing of options. It makes a great deal of sense. But again, this is not investment advice. Contact your financial advisor and make sure this type of transaction is right for you. Have a good day.